Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Yep, it's Charlie Jewett here, and I am in my car. I've never recorded a podcast episode in my car. I know that other podcast hosts do this, and it's probably a very efficient and wise use of time. I've just never done it. I'm supposed to be sitting there in my studio and using the good microphone, which who knows if I even have a good microphone, but this time I'm going to do it in my car because I have an idea and I want to talk about it. You know, hey, who should be on crack? Of all your friends and everyone you love and care about, including yourself and your kids and your parents and your coworkers, you know, who do you think should be on crack cocaine? How about who do you think should be an alcoholic? Who do you think should be abusing alcohol and drinking so much that they're passed out and unable to talk to you or crashing their car or killing people? Who should be on crack cocaine and who should be on alcohol? And let's just ask the question. Who should be invested in stocks, bonds, and mutual funds? And what do all these things have in common? Even going over this with an advisor earlier today, he said, yeah, but stocks, bonds, and mutual funds might work out short term. And I said, so does crack. It gets you through the moment, I've heard. I happen to not have done crack cocaine in my life, which is wonderful. I don't have that experience, but I've certainly had drinks. Does it get you through a moment? Does it work out short term? Yes, it does. Who should be on crack or drinking incredibly high, heavy doses of alcohol, getting through every moment for the rest of their life? Who should do that? And let's talk about why I'm saying who should be on stocks, bonds, and mutual funds. Let's talk about 20 and 30-year-olds. Well, the young people should do it, Charlie, because more risk equals more reward, and over time it makes all kinds of money. No, let's correct that. Over time, last century, it compounded from 1970 to 1999. The S&P 500, if you were in the pure S&P 500 with all dividends, which most of you are not, by the way, if you were in the S&P 500 including all dividends and had no fees, you would have compounded at 13.78% from 1970 to 1999, the end of 1999. That's a 30-year period. That's pretty good. 13.78. Yes. Every honest person, every honest financial advisor using the math, using truth, using reality should have said the risk is worth the reward and you should be in the stock market. That was last century. What should every single honest human being, every honest advisor, everyone who gets paid money to do this professionally, what should people of integrity in this business be telling you today? They should be telling you that with the start of the dot-com bubble, does anybody really think the 90s was normal market behavior and that that's what's normally going to happen every other decade? The growth in the 90s from the dot-com bubble, are you really telling me that you believe your advisor that that's normal behavior and we can count on that? People say, Charlie, you're such a bad guy. You're cherry picking when you start at 2000 and you only go till now. You're not including the 90s. Okay. I'd rather be a cherry picker than immoral and stupid. Including the 90s in regular market performance, in my opinion, and that's why you're here, to hear some truths and to hear my opinion. In my opinion, including the 90s in regular market performance in the future, including a time frame that was explosive while the baby boomers were in their working years, and saying, oh, I'm pretty sure we're still gonna get that, you know, every couple decades, even though the baby boomers are now not putting money into the market, but taking it out to live off of. Against all mathematical realities, I just think we're going to get it, Charlie. I just think, I hope. All right, good luck with that. Hope is not a financial plan. From 2000, January 1st, 2000, until the end of 2019, I'll update my numbers as soon as 2020 closes. That's fine. But during that 20-year period, if you got all the dividends, you were not with a money manager, you just bought the S&P 500 from Vanguard or Fidelity or one of the less expensive places, and you ignore all fees, including the cheap fee you'd get from Vanguard or whatever, if you ignore all fees, get all the dividends, never touch the money for that 20-year period, you only compounded at 6.01%, which underperformed the top annuities, the top cash value life insurance contracts with tax-free growth, and certainly underperformed land banking, which in a 17-year study, the area we invest was going up 30% per year every year for those 17 years. You throw away the top 10, bottom 10%, and it's actually averaged 24% real compounding rate of return. If the stock market has the lowest returns, higher fees, and more risk than the safer alternatives, can you come up with any story where any person of integrity who gets paid to do this professionally doesn't share that with you and charges you a fee to keep you in the market? Can you come up with any excuse for Edward Jones, Merrill Lynch, Morgan Stanley, and Ken Fisher continuing to tell you, or God forbid, Dave Ramsey saying the market makes 12%, that mutual funds make 12%? Shameful, shameful human being. Can you even imagine not being told that the most popular place to grow money in the entire country, as the baby boomers now are retiring, can you think of any excuse for not telling those people that the most popular place to keep their money is performing at 20% to a third of what it used to? Folks, if you don't understand compound interest, the difference between compounding at 13.78 and compounding at 6.01, if you don't understand the difference between those two numbers and what you can take as income and what your account's going to end up at, you better take a look. You're going to be shocked. Go to a future income calculator. Go to Google and type future income calculator. Pick the one from calculator.net or whatever one you want to pick.
We interrupt this program to say that Charlie made a mistake. It's actually not called Future Income Calculator. Please do a search for Future Value Calculator. That would be Future Value Calculator.
Whatever calculator you end up on, just go, over 20 periods, 13.78 per period, start with 200 grand, periodic investment, or how much to add, 0. Just start with 200 grand, compound it at 13.78 over 20 periods, take a look and see what the balance is. And then you go, well, 6 is roughly 45%, 50% of 13.78, so I'll probably end up with half of that. Nope. Go ahead and lower that rate of return to 6.01. Go 20 periods, $200,000 starting, 6.01 compounding, no periodic investment, nothing put in monthly. Just compound that thing for 20 years and see what I'm talking about. And you want to hear something? You want to hear the truth? You want to hear what integrity sounds like in the financial services? If you're taking an income out, the difference between 6% and 13.78 is even more highly exaggerated. You will run out of money. Promise you. You'll run out of money if you're compounding at 6.01 and taking out what Edward Morgan Lynch tells you is safe to take out. They're criminals, folks. It is criminal behavior to get paid and professionally hide the reality, the truth that people need to see to make wise decisions. It is criminal behavior to hide that from human beings and push them into what pays you the highest kickbacks. And every one of those companies that for some reason you're in has a disclosure on their website called the Revenue Sharing Agreement that says they're going to rip you off and put you in not what's best for you, but what gives them kickbacks. Only the marketing companies they're partnered with, who pays lunches for their employees and trains them to use their high, overpriced, underperforming investments. So, I don't know, who should be in stocks, bonds, and mutual funds? The guy in their 20s and 30s because they have a lot of time, and over time the market does better than everything else. No, it doesn't. If you're in your 20s and 30s and you invested in cash value life insurance built the right way, you would end up with 400%, 500%, 600% more money than using stocks, bonds, and mutual funds, even in its heyday. Don't believe me? Write me. Charlie@JewettWealth.com. Write me. Challenge me. Ask me to show you. Charlie@JewettWealth.com. I will show you. Cash value life insurance has a 10 to 12% payout, which means if you accumulate $1 million, you can safely take $100,000 to $120,000 a year, and it will last forever. It will last well past your 120 years old. If you have $1 million in stocks, bonds, and mutual funds, the old, outdated, proven wrong number says you can take $40,000 a year and increase it by 2%. That number is now down to $28,000 or $29,000 if you care about people of integrity who do real math, who stay up to date and don't use numbers from last century. but actually include the crash of 2000, 2008, and the hiccups recently. I don't know why truth is so offensive to people, and they want to, I guess when you confront an alcoholic, they're kind of pissed off about it too, or you tell somebody to get off a crack and they get all crazy on you. It's an addiction. It is an addiction. Should young people who have a lot of time use an inferior investment that's going to be taxed, has no guarantees, and underperforms everything else? No, they shouldn't. So, okay. So the young person shouldn't be in the stock market. Okay, what about the young person who hasn't saved up enough money to replace their retirement income, or somebody in their 30s, 40s, or 50s who wants to retire one day and they're making $50,000 a year and they need to replace that income with income? Should they be gambling, Charlie? The answer is no. There's a very strong argument that you should be funding annuities or something guaranteed until that guaranteed replacement paycheck at your age 62, 65, or 67 when you want to retire is equal to your inflation-adjusted income from today. What do I mean by that? Do you have any money to gamble with, to lose, to make low returns on if you haven't even covered the basics of retirement planning, which is paychecks, replacing your income? The answer is no. What do they say with every investment, every prospectus? Only put money here you can afford to lose. Can you afford to lose it if you haven't saved up enough to replace your income for retirement? The answer is no. Folks, I understand I'm non-traditional. I understand I'm contrarian. I understand your goofy broker doesn't talk like this. That's because I watched a family member work with a goofy broker and come out of retirement and go back to work for 13 years until you've been in that situation. By the way, by definition, if you're 20, 30, 40, 50, or 60, or any age where you have not retired yet, you have zero experience with what gives me the passion to talk to you the way that I do. I'm the one that watched the failed retirement plans. If you haven't retired and failed and gone back to work, you have zero experience with what gives me the passion to be different than Edward Morgan Lynch. Gambling is not a financial plan. Hope is not a financial plan. Looking at what things did last century, when the largest group of humans that's been alive before this most recent one, but the baby boomers, super unique generation, looking at the way the market worked while they were buying stocks and saying, I think it's going to do the same thing while they sell the stocks because I'm on crack. If you think that's going to happen, you're gambling with your retirement. Some decisions have to be made by logic, even though you're an emotional creature. Even though the training, all of the trainings in the financial services are like how to whip you up into an emotional state and put you into a trance. Because it's hard for people to make decisions, and they only make decisions when they feel good, and people move towards pleasure and away from pain and barf, barf, barf. No. Some people are actually pretty intelligent, and you go, this refrigerator costs $17,000. Across the street, the same refrigerator is $1,000. Which one do you want? I don't know. Can you tell me a story and give me a bottle with your name on it and work me up into an emotional state where I can actually make the decision? No, you're better than that. Folks, you're better than that. Edward Jones has a 46-point touch point system. They email you and touch base with you and show up at your kids' funerals and send you birthday cards and all that, and sure, it feels good. And they rip you off and hurt you. Guess what else feels good? Alcohol and crack feel pretty good. I've heard. I've experienced one of them. Feeling good is not the goal. Retiring on a massive retirement income that cannot run out and keeps up with inflation and minimizes taxes so you can finish your life living out your golden years in golden fashion. And if you happen to get sick and it costs $8,000 a month for 4 years, having someone else pay for that, so you preserve the estate to leave to your loved ones, to leave to your favorite charities, or to leave to cats, for heaven's sakes, which I actually know people where their entire estate is going to stray cats. Your passions, your life, your nest egg, your golden years, and you're using strategies that just make your broker rich. And 100% of the evidence shows you're doing it because it feels good and it doesn't work out for you financially. That's why I have a little bit of passion. What is my job as the financial services whistleblower? What's my job as America's retirement pastor? What is my job as Charlie Jewett, investment advisor, head of the Renovating Retirement podcast? My job is to give a spanking to these buffoons who are hurting you and to lead you to safety, to prosperity, to make it so clear that it's easy for you to see and make genius decisions just like you do every day. How many babies have you run over in your car? How many old ladies crossing the street did you just plow through in your pickup truck or your Lamborghini or whatever this year? How did you know to hit the brakes? Because the windshield let you see, and you are a genius when you see. So, what's offensive about the data coming through the windshield that your favorite investment that feels like crack cocaine and alcohol to do every month? What's so hard about this data coming across through the windshield that says it doesn't make as much money as any of the other options? Nothing you could want money to do does the stock market do better than the other options. Oh, what if you're young and you have a lot of time? Life insurance works better. What if you want to guarantee your income and you don't want to gamble until you know you can replace your income? Annuities work better. Well, what if you don't need the income? You just want to grow? Okay, land banking works better. Well, it must mean that it's good for college, right? Shouldn't I use 529 plans? No, you can get tons more money out with way more flexibility from life insurance. Okay, gosh, let me try to think of stocks, bonds, mutual funds. What do they do? What do they do well? Nothing. They used to compound over 10, 20, 30-year periods better than the alternatives. And horse and buggies used to get you where you wanted to go faster than the alternatives, which was walking. How many people do you still see in a horse and buggy? Forget the Amish. How many people do you still see in a horse and buggy in regular cities? Why? Because humans are intelligent. And modern thinking created the car. And so we don't go back to the horse and buggy unless it was an addiction, like you really just liked spine-jarring bumps and the smell of horse manure. All right, whatever. Whatever your thing is, your thing. Whatever floats your boat, dude. Most people drive a car because it's a better technology. We fixed the broken old system of why does it take so long to get there and it smells like horse poop with the car. How did we fix the system of the stock market? You can lose a ton of money. It has high fees. It doesn't do income well. It stopped performing. For the last 20 years, it's only at 6.01 instead of 13.7. What fixed that? What's the car to the horse and buggy of the stock market? Indexed annuities? Indexed annuities with an income rider? Cash value life insurance built the right way, which you cannot study on. Folks, if you try to study infinite banking, be your own banker, bank on yourself, whole life, indexed universal life, if you try to study that online without the help of someone on my team, you will drive yourself insane. I know agents who have left the industry over the battle between whole life agents and indexed universal life agents. Do you know how stupid that is? Do you know how stupid it is that there's a battle between two types of insurance? Do you know how criminally immoral one side of that battle has to be to even argue or fight? Nobody on our side is arguing. Indexed universal life's the answer to everything. It's better. Indexed universal life itself was the car created because whole life, the horse and buggy, sucked so bad. Todd Langford, Garrett Gunderson, Pamela Yellen, all these cowards, these shameful coward buffoons, none of which will stand up to me, none of which will argue with Rob Hodges, none of which will respond to my podcast episodes. Cowards selling software to hurt you. How do you know someone is a criminal? When they're shown the truth and they have a choice, a chance to repent and honor the truth, they hide and still have workshops selling their criminal software, hurting people by jamming them in inferior horse and buggy investments. Todd, I'm right here, buddy. Garrett, I'm right here, big boy. Pamela Yellen, right here. Read your book a ton. Whole life is trash the way you guys design it. And there's still time to repent and ask the people you've hurt to forgive you. And 1035 those policies, 1035 exchange those policies to a car design, not a horse and buggy design. And if you don't, I will. I don't know how it could sound arrogant to say, you know what, I think 2 plus 2 is 4. And you guys have a bunch of published materials and hold workshops saying 2 plus 2 is 5. Would you mind if we just came together publicly and brought a bunch of apples out and put 2 on the table and 2 next to it and then counted those apples and see if it's 4 or 5? Would that be okay? Since the recommendations you're making determine how much income someone has for the rest of their life and the net worth of every generation after them, would it be okay to just be careful and see which is true? What you can know, my listeners, by the way, they have much bigger audiences than I do. The amount of people they hurt is a much bigger number than the amount of people I help. They are more successful than me. They've done a very good job building a cult of people that they damage and harm and then hide from me and not debate the truth for some unknown reason. Why? Why? Why does a human need to hurt people to make a commission? And then when someone shows up and says, I can show you how to do it even better, how to help them and make a commission, I'm not going to change because I'm addicted to whole life insurance like it's crack cocaine. Don't bring your stupid improvements to me. I'm going to stay in the horse and buggy no matter how many companies build a car. Why work with criminal, immoral robots stuck in the old world instead of moving to the new world? Other than that, I don't have any strong opinions on the subject. Hello! You guys know me. If Todd Langford showed up and said, I will participate in the debate, Rob Hodges and I would show up humble and say, please teach us, Todd, how today's best whole life designs somehow improve upon the fact that whole life was so bad that the E.F. Hutton organization had to create universal life to fix all the problems in whole life. And indexed universal life and universal life have just gotten better since that day. The whole life companies, let's give them the benefit of the doubt and say they've improved their designs too. Please show us the absolute best design for a whole life policy with $1,000 a month going in for 30 years and then turning on income, or a lump sum $500,000 up front coming from an inheritance, going in as fast as you can put it in and then turning on an income at age 65 or whatever. Show us the best design. When we come back and destroy that design, when you say this is the best, and we come back with 2, 3, 4 times as much income, more arbitrage, less opportunity cost, more long-term care, more death benefit, more liquidity, and say, well, we could do this. That's a horse and buggy. We have a car. If you have any other answer than humility, please teach me and my company how to do that. You're a criminal. I mean, just hiding from the debate, you're a criminal. It's upsetting. I'm a little tiny peon in this industry, and I'm a human. There's things I didn't know 2 years ago, and then I learned them, which means every second of my life is spent saying, there's some things I'm probably wrong about. There's some things I probably don't know yet that are true. That's called humility and integrity. And I didn't make it up. It's just one of the things I care about that happens to be there. But what do you do with people that don't have that? That go, hey, every time I learn something better than what I do, I hide behind my software and my conferences and I continue to hurt people. I don't do my... If your advisor or insurance agent will not even do the due diligence to compare different types of life insurance product, how in the world could you possibly think they're giving you the best design in the product that they are offering you? It takes us hundreds of illustrations sometimes for one client using one tool to get the best design. How are they ruling out an entire world of tools? We don't rule whole life out. It's just every time you compare whole life to index universal life, it sucks. I couldn't do that to someone. That's criminal behavior. I'm a fiduciary, for heaven's sakes. You can't give somebody an inferior policy and go, I'm just more comfortable with the company and it fits my software because I'm a criminal. Back to the stock market. Crack, cocaine, alcohol, other addictions. You're in the stock market. Let's be honest. You're in the stock market because you like how it feels. It's not good for you. Lowest retirement income of almost every option besides sticking it in CDs. Every other real solution that the industry has, every other tool that's made for when you switch from the accumulation phase to the distribution phase of your life, which was the only reason you even accumulated. The entire thing has been about getting the money back monthly when you stop working. Every tool, besides CDs basically, that's designed for that time frame gives you a higher income than the stock market with lower risk. But you're in the stock market because it feels good. I have an 84-year-old in my life I met taking $10,000 a month out of a portfolio of stocks, bonds, and mutual funds. 84 taking money out of stocks, bonds, and mutual funds. This lady graduated the need for stocks, bonds, and mutual funds 20 or 30 years ago, and every competitor except CDs would give her higher income, more safety, income that lasts longer, leave more money to loved ones, increasing income, more money for long-term care. But there's an advisor getting paid to convince her that stocks, bonds, and mutual funds make 7 or 8% per year. Criminal. The fact that criminals exist, you don't have to get depressed about. If you're still in stocks, bonds, and mutual funds, I'm going to challenge you to compare to the options you're not aware of because they have been hidden from you. What you're going to find is that it's easier, the path of least resistance is to do the same thing. It's easier to follow the crowd. The stock market is very popular. It's what your parents did. It's what your neighbors do. All of it's easier, and it's much easier to just do crack and not face your problems today. It's much easier to get drunk and not face your problems. If you have courage and you truly want to know and do what is best for you, if you have that level of discipline in your life, get in touch. Charlie@jewettwealth.com, CHARLIE @JEWETTwealth.com. By the way, I've been posting a series of short videos called the Something to Think About series, and they're getting very popular. More views than any videos I ever post, probably because they're only 2 to 10 minutes long. There's 5 of them already when I'm recording this, but go to charliesvideos.com, CHARLIES, videos, plural.com. charliesvideos.com is my YouTube station, and subscribe, and you can see the videos I'm posting called the Something to Think About series, where every one of them ends with, I bet your broker never told you that, but it's something to think about. Folks, alcohol, crack cocaine, and the stock market, all unnecessary tools that do not do good for you long term. I could not have said that in the late 90s, but I can tell you that now because I actually pay attention to the numbers. Why do I do this? Because I think you people are the best. Ciao, ciao.
Renovating retirement with Charlie Jewett.
But that's all, folks.